All right, everybody, welcome to another edition of Market Talks with Dr. Stoxx. It is the 6th of December. It's a Friday. We're ready and waiting for the weekend to start. It's been a long week, but also a very good one. We've made money every week, every day this week, and we've made money this week, previous week, previous week, previous week. I think we have to go back to mid-July before we have a week in the live trading room where we've actually lost some money. So it's been a good stretch, but the market, of course, is now up at all-time highs and starting to show a little bit of distribution, a little bit of bearish divergence, probably ready for at least a minor sell off, a minor consolidation. Nothing to get too worried about. There are plenty of tailwinds, but it's not a real good time right now to get heavy long. So we'll have to be very careful going forward. We don't want to get complacent. We don't want to get caught up in some nasty thing that comes out of the left field and throws the market for a loop for a couple of days, because that's the kind of thing that typically happens when you get up at these kinds of levels without much in the way of a pullback. We haven't had really a pullback for about a month and a half. All right, so here's what we're going to do today. It's Friday, so it is the day that we roll out our weekly option income plays, and we take a couple of different approaches to the market when we do these plays. Right now, we're focusing on a hedged, protected position so that our losses are capped, just in case we do get into some thick volatility in the market, which I think we probably will get into fairly soon. And the way we do this is, and let me show you a chart here. First of all, I'm coming to you live from the Dr. Stoxx trading room, which if you want to join me throughout the trading day and a big group of amazing people at all levels of trading experience, click on the red live button. Sorry, not the red live button. Click on the live trading room button on the drstoxx.com website. That's drstoxx.com, and you'll be able to join us from there. So let's take a quick look at the chart, and I'll explain how we put these on. So we've had actually a position in NVDA, and we're going to be closing this one out because we've taken some good money on it, but it is one of those stocks that I think is probably ready to come back in for a week or two. And the market has been quite strong today, and NVIDIA itself is down. It's weak today, along with the sector, the semiconductor sector. So when you see weakness in a strong leading name, even if the rest of the market is doing okay, that's a red flag. So we don't want to be in NVIDIA if it's going to come down 3 or 4%. That would be a bit painful. We've also got a 3-bar reversal printing here at a lower high, which also in and of itself is not very good. Plus overbought stochastics, and there are all kinds of reasons why we think the market is going to be just a little bit on the weaker side next week. Nothing major, nothing to get concerned about. Don't run for the hills. Don't move everything to cash. Just be a bit cautious and don't get too hungry on the long side. So here's how we put on these spreads: the Diagonal Debit Spread. It's a debit spread because we will have to pay out some money. The cost basis of the position will be made back in about 2 weeks, sometimes 3 weeks, depending on how much premium is there. But it does take a couple of weeks for us to make profits on these positions. We do this in 2 legs. So we first of all put on let me get my pen up here. We put on a long put over a period of time, typically 2 months or so. The best time to do these, by the way, are right after earnings. And NVIDIA reported earnings just about a week and a half ago. Do them right after earnings, and you can put these on for about 3 months, so you don't have to worry about earnings. We find a level of support, and that's the strike price that we use for the long put. This is our protection put. This is insurance. We're going to buy this put. We're going to hold on to it. We plan to let it expire completely worthless, with the stock trading well above that strike price over time. And that's the cost basis of the position. But you'll be glad you have it on if the stock goes south. So right now, 136 is a good level of support for NVIDIA. So if we were putting this on today, the um, we would buy a long put, probably going out to January, the third Friday in January, maybe out to February. It depends a little bit on how bullish we are going forward. And that is our cost basis for the position. Let me do this in a little cleaner way. Doggone it. Okay, so 136, we buy the put this Friday, and let's go out. Let's pretend we're going out to the third Friday in January, which is right about there. So that's our protection. If the price goes below that level, we will not lose a single penny. We will, of course, lose some money on the way down, but if it gets past that level, that's our cap on the loss. And then from this Friday to the next Friday, and every Friday thereafter, we will be selling short a put, the same number of puts as we have on the long side, pretty much at the strike price that we'll use is the at the money price, as close to it as possible. We'll come down a strike or two if we think the market might be a little soft. We'll go up a strike or two if we think it really has good upside potential. But every week, every Friday, we sell those puts. We take that profit, goes right into our bank account. Typically, after 2 weeks, sometimes 3, we've made back the cost of the long put. And then every put after that we sell short is pure profit. By the time we get out to the middle of January, we probably have sold 6 or 7 puts, and we've banked good profits on all of those. All right. The only time we don't make money on these is if it goes down to that long strike price. We will lose some money in that case, but we're not losing as much as the gap between current price and the strike of the long put because of that premium that we've been selling week after week after week. That gives us a nice cushion on the downside. So that's what we're doing here. Now, we already have on several positions, which I'll do off camera. I'll roll those out with our members. The second thing I wanted to do, however, with everybody is to determine which of a short list of candidates would be the best one to replace NVIDIA. We're closing out NVIDIA. We're taking a smallish profit on it, right? We lost some money on the long put. We made money on the short puts. We've made more money on the short puts than on the long put. We just haven't been in it very long, so it hasn't been able to make a lot of money for us. But hey, the actual price of the stock probably hasn't budged very much since we started this. Maybe it's even down a little bit, but we'll walk away from it with some cash in our pockets. That's always a good thing, right? All right, so let me show you some of the stocks that I am interested in replacing NVIDIA with. One is KKR, which is in the very strong asset management space. It is one of the better ones, one of the ones that typically rises to the top of the list. Nice bullish chart, stacked MAs, little pullback here. And look, the market is up at all-time highs. It has already pulled back a bit. So that's a good thing. Some of the risk is taken out of the trade. It's pulled back into the rising midline of the LRC, the linear regression channel. That's usually a good place to get long. I frankly think this would make a very nice swing trade, not just a diagonal debit spread. But we've done these on this particular stock before. We know that it is a good candidate for this. It has weekly options. The weekly options are liquid. The weekly options have very nice premium. Typically takes you a couple of weeks to make the cost basis back. And the company, the stock, the chart, everything on this is bullish, bullish, bullish. All right. So there's KKR. That's one candidate. I'm going to mark this in my little list here with a green. Another one is VRT, which is a utility play, typically in the IBD top 50 list, and sometimes it's even up in the top 10 list. And it is a very strong company, good growth, lots of good bullishness here. We've got very good volume balance down below. We've got oversold stochastics. We've got a nice little pullback to the 21 EMA, bouncing very cleanly. The only thing I don't like about the chart is that it is down today when most of the rest of the market is doing okay. It's a kind of a mixed market, to be honest. We've got the Dow Jones down a little bit. We've got the Russell kind of falling back to flat, and we've got the S&P just above profit, and the Nasdaq is the only index, the major index, doing really well. So, with that said, VRT is on the short list. We'll take a look at some of its fundamental metrics in just a minute. Another one that I'm looking at, and this is the one that I'm kind of leaning toward here, is Google. So, Google has been in this nice looking consolidation among the MAG or FANG group. It's not one of the better ones. it's been it's been a laggard, and that to me signals that it is time to play some catch up. What I also like about this is that you are in a fairly narrow range, and it's getting narrower and narrower. We're getting closer and closer to the apex, which is a very good setup for this strategy. We don't need these to go up. We really don't want them to go down, but if they do, we're capped, right? Our loss is capped. We only need them to be kind of quiet, just churn around a couple of days up, a couple of days down, somewhere in the middle of the range. And we're very happy because we will take all that premium as the time decay just melts and melts and melts day after day throughout the week. And we can go home on Friday banking at least a majority of the time value of that put as we roll it out to the next week. So this is a good candidate for that. It is nice and up today, nice and strong today. It's bouncing quite cleanly off the 200 period moving average. The MAs are stacked. The LRC is rising, but not in a super strong way, as we saw with KKR, for example, or VRT. I like it. I like it as a catch-up play. We saw Microsoft in the very same pattern last week, and it broke out this week. I think next week it's Google's turn. Regardless of what the market does, I think Google it's been hampered by some saber rattling from the current administration, talking about breaking up the company and because of antitrust laws. With the new administration coming in about a month, I don't think that's going to happen. So I don't think that is anything to worry too much about if you're a Google fan or an investor in Google. So anyway, I like it. I think it's set up quite nicely for at least a couple more weeks. And earnings are not until early February, so we can roll this one out to late January. A couple of others here. Let's take a look at Shopify. All right, so Shopify is up, up, up. This is a power gap setup on earnings. Power gap is where you gap up on some really good news, and it hits a new 52-week high. Usually, typically, you get a little bit of a pullback, but we don't want to see that gap close. A little pullback into the top of the gap is fine, and that's often, in this case, it really was, a very good place to get on board this stock. You don't buy it on the day of the earnings. You don't buy it the day after the earnings. You buy it on that first pullback. And it also broke out. So another place to buy it is you watch the pullback, you mark the resistance highs, and then you buy it on the breakout. That also could have been a nice place to buy. Now, it's up at new all-time highs after breaking out of a little consolidation, a little 4-bar consolidation right there. This is just bullish, 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 bullish. Now, that doesn't mean that it's going to continue to be bullish, but we would be very happy in a position selling premium on a week-to-week basis if this merely went sideways. And I think the risk of this going down, at least down below, let's say 115 or so, the risk of that happening on any given week is pretty low because the momentum is up. The valuations are now matching price. It's just a whole new day for Shopify. So Shopify is on our list, and I'm going to add one more, which probably won't pass muster when we start digging down into the metrics, and that is a Chinese play called PDD Holdings. I don't really know what this does. This is what I know about China. It's been having some trouble because of the economy slowing down very fast. The government has been stepping in, printing money, stimulus, lowering interest rates. they're doing whatever they can to try to get the market propped up again, and they're fiddling with the yuan as well. And just this morning, the headlines were that the government was going to lower rates even further than they thought. So that should be a good stimulus. It should be a good bid under these Chinese stocks that have had such a strong fall. This is one of the best. This is one of the strongest companies fundamentally. You can see the chart is not that great. It's a downtrending chart. The MAs are not stacked. But as we look at the fundamentals, you'll see that there's some very good things going on here. So this could be a good recovery play, right? Kind of the opposite of Shopify. Shopify is really strong because of the new earnings. It's a new level of valuation. There's probably not much downside risk. And to be fair, there's probably not a whole lot of upside either. It's going to have to cool off for a while and consolidate. This one has more upside potential, and it's likely, given all that new macro environment, that the downside, the worst of it, the worst of the pullback is done. So 96, right, was the low of a few days ago, and that is probably it on this pullback. Probably. You never really know. Stock market can always do what it wants to do. Stocks they have a mind of their own. But on a risk to reward basis, I like this. I like the ratio here. So we could sell the 100 puts this week. We would buy long the 96 puts, assuming that it has dollar strikes. Some of them don't. Going out for a couple of months, and we just continue to sell the at the money puts until that runs out. All right, that's one possibility, and we have what was the other one? VRT. So we have 4. Let's mark these with green. And here's what we're going to do. I'm going to do 2 things. I'm going to go to 2 different sites to determine objectively which of these 4 is the strongest. Again, I'm leaning toward Google because of that nice setup and the fact that it's a Mag 7 and it has to play some catch up. But I can be convinced otherwise. And frankly, I've looked at the options of each of these, and they all have really nice premium. We will be doing really well to get on board any of them, I'm pretty sure. So first thing we're going to do is go to, if I can find it over here, give me a moment. We're going to pull over my handy dandy market search tool. This is a screening and charting tool that is offered by Investors Business Daily. I am a partner of Investors Business Daily. I can hook you guys up with a very cheap trial, 2 months for about $50. And right now they do have a modified trial, 5 weeks for $40. If you're interested in that, let me know. I'll send you a link in the live trading room. So here's what we're going to do. We're going to put one of these, each of these in by one. Let me get back to my list on this other screen so that I know which ones we're looking at. Okay, got it. All right, so let's do these one by one. We'll start with PDD, which is the last one we looked at. It's the Chinese play. Now, if you go over to this little box right here, these are the numbers that we will be using to make an objective analysis. One of the first things I look at is the EPS rating. This is your earnings per share growth. It also involves things like accelerating earnings over time. So it's not just growing, but it's growing at an accelerating rate. How much of the earnings report in the last few quarters were above consensus, right? Surprising to the upside. That's always good. How much are they raising their forward guidance on earnings? All of that is computed, and a number is spit out, and you can't get any higher than 99. 99 is the perfect number for earnings. So on an earnings basis, PDD is excellent, right? It's a 99, doesn't get any better than that. It's in a strong sector, B+. SMR is the second thing I look at. Sales growth, accelerating sales growth, revenues, and so on. Margins, are they getting bigger over time, or are they contracting? How are they relative to other peers in the industry? And R, it stands for return on equity, which is in my opinion, is the best measurement on whether the company is well managed. you have smart conservative management, if you have a strong return on equity grade. You put all those three together, and I like to call that the moat around the company itself. You've got pricing power, you've got protection from competition, you've got strong conservative management. If you have a good grade there, and this is as good as it gets, you can't get higher than an A. Now, you put it all together, though, in a comp score. This is kind of the bottom line score, which takes into account relative strength. And you can see the RS rating down over here in the lower right-hand corner is not very good. 99 is the highest. Those are the stocks with the highest price movement. And 17 is really pretty bad. So on a price basis, not doing very well. That can, of course, work very much in our favor. It's undervalued. The low is already in. It's only upside from here. So that is potentially a positive, but overall, we would kind of like to see something that is at least uptrending, and this is not. This is still downtrending. So it's a possible candidate, but it probably is not going to be our best. Let's take a look at the others real quick. ARM. Did I say ARM? I don't think we looked at the chart of ARM. Oh, it's not on my short list over there. I'm sorry. What is it that Google is the one I'm missing? There we go. Okay, forget ARM. I forget that I said that. I think ARM will be a good candidate. Nothing wrong with it necessarily. It has very rich premium. Fundamentals are okay. It's just that it's in that semiconductor space. If you got NVIDIA not doing all that well, this one is probably not going to do that well either. So we'll wait on this one for a week or two. However, let's take a look at Google and compare. Okay, so you can see a 97 EPS. That's very, very good. ASMR can't get any better than that. And a 90 comp is much better than the 70-something we saw with PDD. So all of that is good. The only reason why it's not higher than a 90 is because the RS rating is fairly low, right? It's down to 68. It's been up here, I don't know what that would be. Probably up here it's in the 90s. Down here it's in the 68s. So, so on a price basis, we've got some problems. On a fundamental basis, in terms of its growth and sales and everything else, still very good. All right, so that's Google. Let's take a look at VRT. All right, so you can see these numbers, right? These are the numbers that you would drool for. 98 EPS, ASMR, 99 comp, doesn't get any better than that. And we can even look at the timeliness rating, which is the IBD rating for technical strength. And it's an A. It doesn't get any better than that. RS rating of 97. Those are very, very good numbers. So per IBD market surge, VRT is the winner. But we have one more to take a look at. Let's see what KKR looks like. All right, KKR also very, very good. 93 EPS, ASMR, 98 comp, A timeliness, and a 94 RS. So these numbers are also very good. Not quite as high as VRT. So VRT has the edge, then KKR, then Google. PDD, I think we're going to have to forget about for now. So with that in mind, let's go over to TipRanks, which is the other site I like to use to do some objective analysis on a stock's ratings among people that know what they're doing. People who actually went to school for economics. I was philosophy and theology. That's what I have my doctorate in. I have 2 master's degree and a doctorate. The doctorate from Oxford in theology and philosophy. It has nothing to do with the market. But nevertheless, I think it actually gives me an edge because philosophically, I'm looking very objectively at things, and I can analyze my own thinking process. And theological is really a training in interpretation. So, you're interpreting ancient texts, you're interpreting the writings of the saints and so on. Here we're interpreting charts, we're interpreting numbers and so on. It's a very similar kind of process. All right, let's take a look at those 4 stocks. So let's start with VRT. And here's what we're looking for. We want to see, is it a strong buy or something less? This is a strong buy. We want to see a positive price target consensus. It doesn't have to be very big. We're not looking for a huge 40% number here. We're just looking for a price consensus that's above current price, and it is. And then we scroll down to look at who are the analysts that are saying these things. We don't want to see 1 star, 2 star, 3 stars in the list. We want to see 5-star guys that have really good track records. You don't get a 5-star on tip ranks unless you've got like about a 70% win rate and 15% average return on your buy ratings. If you've got those two or better, you've got 5 stars for sure on tip rank. So these are guys that have a very good track record. Now we could also look at to see what firms they're from, because in my head I've got like a list of 5 firms that are the best in the industry, and if I see 5-star analysts from those firms, that's like a double whammy. The only one that's in here that is of that caliber is Oppenheimer. That's one of the 5-star guy from Oppenheimer, and he has a buy rating on it that's good. And it was, about 3 weeks ago, so it's a little bit stale, and it's already gone past his price target. So, and it was a raised price target. All right. So anyway, that's VRT. This is good, right? It's all good. That's exactly what we want to see. KKR, strong buy. Also, upside target. It doesn't have to be much. We just need to see it above current price. Here's some 5-star. There's a lot of 5 stars here as well. Most of them are on buy. Most of them still have some upside to get to their targets. And the most recent guy was like a 4.5 star. We're not too interested in him. The rest are still a little bit on the stale side. Okay, so this KKR, also good, right? VRT, KKR, both good. Let's take a look at Google. Strong buy. All right, with a bigger price target. So we do have a little bit more upside here before we start hitting the consensus. And these are all 5 stars, right? All 5 stars right down the line. And they're all still with some good upside to, give me just one moment here. Hold on a minute. Okay. So all still with a good upside to hit their price targets. And, we've got some guys that are really recent. That helps a lot because that means their analysis is fresh. We're not in these very long. We're in these sometimes only a week or two, and sometimes 2 or 3 months, but no longer than that. So we want these analyses to be fairly recent. We want to see some good 5 stars. And I'm looking, BMO is good. Goldman Sachs, I would say, is kind of in the second tier. Stifel Nicholas is good. None of these are in the top 5, I have to say, but they're in sort of the second tier. All right, so that's Google. And what was the 4th one? We're not going to do PDD. Shopify. All right, so clearly Shopify is not the one we want, right? It's a moderate buy. We are currently above the price target. And yeah, there are some 5-star guys in here, but not everybody is. And this reported earnings not too long ago, so all these are really fresh. That's a good thing. But yeah, we're just, there's several holds in there. There are, the price has already gone further than they thought it would. There are some 3-star and 4-star guys in the mix, but really it's this one right here and this one right here that says, okay, Shopify is off the list. So Google, VRT, KKR, those are the 3. I was leaning toward Google, but I'm kind of thinking maybe one of the other 2. Let's take a look at the charts one last time, and then we'll decide. VRT, that red bar today is a little bit concerning, and if you look down at the bottom, you're going to see a whole stretch right in here where there's a fair bit of distribution. So VRT, I would put that in the 3rd place. KKR, nice little 4-bar pullback. We've got this oversold stochastics. I can't even see what the volume bars are down there because of that. See if I can get that off. There we go. It's been a little bit distributive here in recent trading. This is good right in here, right? Volume balance, leaning bullish. Volume balance here, leaning bearish here. Mixed in this area, very bullish right there. So there's KKR, and then there's Google, which is the one I kind of want to do. The only problem is that it is overbought stochastics. We do have recent bullish, prior to that leaning bearish. Well, we don't have to do any of these, frankly. We could just wait. We could just wait for a couple of days and look at them again on Monday. Here's the one last thing. Let's do this. So let's rule off VRT. It's either going to be KKR or Google. And in order to do that, we have to drill down to the option tree and see which of those two is going to pay us more money, which one is going to be giving us a higher percentage on the premium. So for that, we have to drill down into the option tree. We'll do that together. But between now and then, I'm going to have to stop this video, get it going on the production side, and then I'll join you back in the room in just a minute. Bye for now. God bless. Thank you for watching, and I'll be back with everybody in just a minute.